All right. It's 10 up 11 o'clock. All right. So it is 11 o'clock. 11 o'clock. You know what that means? Let's get started. Today, here at the Commercial Multifamily Mastermind Underwriting Show, we have a special guest. So I'm thrilled to have all of you here today as we explore I'm going to say the critical role underwriting, okay, and in a successful real estate investment. But today we're honored to be joined with Mitch Messer. Mitch Messer is a seasoned real estate investor with over 2 decades of experience. Mitch began his journey in 1999 and by 2006 had built a rental portfolio worth over $6 million. I said that. Despite facing significant challenges during the Great Recession, Mitch's resilience and wisdom helped him rebuild stronger, leading to an international investment operation backed by over $2 million in private lending funds. Today, Mitch works with private investors across the United States and globally, funding and developing impactful real estate projects. He's here to share his wealth of knowledge and the lessons he's learned about the importance of underwriting, offering insights that are invaluable to both seasoned investors and those just getting started. So please let's join and welcome Mitch Messer. Mitch, welcome. How you doing?
Thank you. I'm doing great. That was an amazing introduction. I feel like I need to sit back and listen to whoever that guy is that you're talking about talk. Um, but yeah, thank you so much. I am honored and delighted to be here. I love talking to real estate investors all the time. It's my happy activity, and so I'm glad to be here with all of you.
Oh, thank you, and thank you for coming. So now I read your bio. I took a little bit. Is there anything you would like to add to that, or something that you may want to correct me on?
No, it's all correct. I do want to. So first of all, I'm hoping you can't hear the background noise. They're doing some sort of constructions building that I'm in. We'll talk about that in a minute.
Well,
But
you
um,
got a good. You have a good mic because it's canceling that noise out very well.
nice. I have this little software program called Crisp, which apparently filters out all the background noise. I've needed that because sometimes there's dogs barking in the background or people walking down the street selling stuff. We'll talk about that in a second as well. But I do want to I want to talk a little bit about my real estate background, and I want to talk about what happened before the background because a lot of times people talk about the real estate career and they kind of drop that on people as if it happened out of nowhere. And I want to kind of explain where I came from and how I got to real estate investing. I think that will be helpful for people to
Okay.
know. So I did, like many people have done, I did the corporate thing for 7 years. I worked for AT&T as an engineer. I went to school for engineering. We'll talk about that in a second as well. But I'm trained as an engineer, and I left AT&T around the 92-ish to go on and do my own thing. I was not doing real estate. I was actually doing .com related stuff. And for those of you who may have been around in the late 90s, the dot-com thing melted down entirely. I got out just before it completely tanked. And in 1999, I decided to do something different. And my wife and I decided to get into real estate investing. We'd always had an interest in it, and we took the plunge and started actively real estate investing in Atlanta, Georgia in 1999. And I tell people that our experience real estate investing was a little bit unusual in that we didn't take the traditional route of investing that a lot of people do. We have been investing now for 25 years. We have never, ever gone to a bank to get a bank loan to buy invest in real estate, ever. We have done private money, we have done seller financing, we have done subject to, but we don't do banks.
Really?
And that's, yeah, that's good and that's challenging. We'll talk about that as well. But I want to set that up because we were in 1999. We did our very first deal. We actually bought the house next door to us. We were living in a condo. We bought the house next door, and we bought it, fixed it, and flipped it. And we liked that. We liked how that worked. We actually used a line of credit to do that. But after that, we decided to start looking at other deals that we could do, and we started uh, learning about other strategies for acquiring real estate, in particular, subject to buying something subject to the existing mortgage, which is an extremely powerful strategy, but it can be very, very dangerous. And so I tell people, subject to is certainly worth understanding, but you've got to have the right paperwork. You have to have the right training, otherwise it can crush you. Well, it is embarrassing to admit that, as I said before, I'm an engineer, went to MIT, got the degree. However, all that sounds good, but unfortunately, I did not run my numbers. So from 1999 to 2006, we made money, as in we took money in, but what we did not do is understand expenses and capex and net operating income. And so while we thought we were doing well because we were collecting money from tenants, which we were sending money right back out the door in expenses. And so our actual margins, our cash flow, our monthly cash flow was razor thin. But I didn't know it was razor thin. So if you'd asked me in 2006 what my cash flow was, otherwise you would have shot me in the head, you'd have to kill me because I would have had no idea. And it's embarrassing to have to admit that because it's not that I couldn't do the math. It's not that I didn't understand the way it works. It wasn't sophisticated math. It didn't require calculus or different. This is addition, subtraction, multiplication, division. Every now and then you get an exponential in there. It's not complicated stuff. I just didn't do it because I didn't understand
Right.
the importance of it. And so that was the beginning. I tell people I am a cautionary tale about what happens when you don't properly underwrite your real estate portfolio because you think everything's going well, but you don't really know until you run the numbers. And unfortunately, as those of us who survived it know, in 2006, 2007, the markets pretty much worldwide collapsed. In Atlanta, we saw rents retreat by about 20%. So things that were renting for 1,000 were now renting for 800. And we saw equities take a haircut. So valuations took a haircut of about 25%. So in many situations, we were finding ourselves where we had a decent sized portfolio of properties, but now we were underwater, severely underwater. And a couple of $100 underwater isn't the worst thing in the world. If you only got one
Like,
property, you
like,
try 35.
wow.
And so you got these things dragging you to the bottom every single month, and you can't sell it because you're underwater. So you can't, you're not making any money, you're losing money every month, and you can't sell it because you owe more than it's worth. So if you tried to sell it, you'd have to come to the closing table with cash, which we didn't have. So it's a lose-lose proposition. And it wasn't just us. Everybody not everybody, many people who suffered through that experienced the same thing, but it was not fun. And I attribute 90% of that pain and suffering to not understanding how the numbers worked. And so I became, shortly thereafter, a zealot, an apostle for underwriting and financial understanding because I've seen what happens when you don't run the numbers. And I've heard this before. Oh, the appreciation will bail me out. Don't worry about the cash flow. The appreciation will take care of you. I've seen that movie before, and it does not end well for anybody. And so, and I'm hearing that more and more these days. People say, oh, don't worry about the cash flow. Just make sure that you're getting great appreciation. But you can't eat appreciation and you can't control appreciation, and it can
Right.
go away overnight, which is exactly what happened in 2006 and 2007. So that that began my journey to understanding how to assess risk and how to manage down risks in real estate investing, because that is pretty much the ball game. If you're not doing that, you're not investing. You're gambling. You're speculating, and eventually you're gonna bet wrong, and it's gonna be painful. It's gonna be the world's gonna come crashing down around your ears.
Mitch, I'm gonna tell you something. You said so much, and I haven't even asked the first question. You, listen, everyone. I'm gonna tell you this right here. My personal opinion is, and I say this on every show. If you don't know how to underwrite, do not expect to get any money, and don't expect you're going to get far. Underwriting is one of the most important parts of commercial multifamily, no, commercial real estate. But you got to underwrite all commercial properties. You heard what Mitch said, but I guarantee you this, he grew from that. Mitch, please, I, before I get into the questions, let's let's jump into your growth by all of that happening, by the mistakes that were made. How much did you grow?
Well, let's talk about how much I was in debt.
Oh,
That
right.
experience left me, or left my wife and I, roughly $6 million in debt. So, yeah, exactly. So when we see, we'll watch TV sometimes, we'll see someone talk about how they're in debt. Oh, I'm $100,000 in debt. My wife and I look at each other and go, "Isn't that cute? Isn't that the most adorable thing you've ever seen? $100,000 in debt." No,
That,
$6 million in debt. Now, some of it was bank debt, some of it was private lender debt, because we had private lenders. But
okay.
these private lenders, and he said, "Why did you just file bankruptcy?" Well, because these private lenders were friends and family. And we didn't want to file bankruptcy and wipe out our friends and family. And so we made the decision, we made the conscious decision to shoulder that debt and work to pay it off. And full disclosure, we're not done yet. We paid off $4 million in debt in 4 years, between 2014 and 2018, give or take. So $1 million in debt per year for 4 years, because that was our mission. Our mission was to get every last one of our private lenders paid back and to make sure
Right.
that we were able to make these people whole.
So, how did you do that?
Well, I can tell you that it was a lot of sleepless nights and a whole lot of work. We sold the vast majority of the portfolio. I mean, the good news is that in 2008, 9, 10, the market was awful, right? You couldn't give away real estate back then. Things started to get gradually better, and as it got gradually better, we had a little bit more of a cushion, so we could start selling assets. But the 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 mental trauma of that experience is crushing. I mean, again, people crumble for $100,000 worth of debt. Imagine $6 million worth of debt
Yeah.
every single day, and you feel like you well, you did this, right? I mean, yes, we didn't single-handedly cause the Great Recession, but it happened on our watch, and we felt responsible to our friends and our family who had lent us money to pay them back, and we still do. And so it was it was an emotional thing, and you got the whole guilt thing. I mean, the guilt and the shame, all that stuff. We had a big sandwich of guilt, shame, and badness going on there. And it took us a while to overcome that. But the the solution involved things like wholesale. We transitioned to, okay, let's learn how to wholesale. So we're gonna,
Right.
because and I want to make this point so that everybody hears me. In 2006 and 2007, we got crushed. At the exact same time, there were people who were buying assets 10, 20 cents on the dollar, buying from people like me who were trying to sell, who made a fortune at that time. So I don't want people to hear the lesson that the market went horribly wrong. The market went horribly wrong for people like me who didn't understand their numbers. People who understood what they were doing, they were buying like crazy in 2007, 8, 9, 10, 11. And those folks got rich, seriously rich, capital R rich.
Mhm.
And so I want people to hear that the opportunities exist. I mean, this is Warren Buffett, right? When money's made when there's blood in the streets. There was blood in the streets in 2007, and a lot of it was my blood. And so, but there were people out there who understood what was going on, and they understood that this happens in cycles. And so they were ready with tons of cash, and they went out and bought everything that they could. And to my everlasting shame, if I had known back then how to wholesale, I could have
Right.
helped those people who had money find deals. I could find other people like me in the same spot that I was in, and help them buy those deals from those other people and made money. So the lesson here is not that bad stuff happens. I didn't know enough to make the most of what was a bad situation, but I could have made that situation pay because people were buying like crazy. And
Right.
I would have happily wholesaled if I had known how. I didn't know how to wholesale in 2007. And so we fixed that in 2014, 2015, we started learning how to wholesale. Well, guess what? 99% of wholesaling is underwriting. It's understanding the numbers. I can't tell you how many people put wholesale deals out there, and you look at it and you go, dude, this is not a deal. Why are you putting this in front of me? This doesn't even make sense. And they
Right.
and they don't know. And that's the part that's embarrassing. I mean, if you put a deal out there hoping people don't notice, that's one thing. But if you have no idea that this is an actual deal or not, you
Exactly.
should. You're not
So,
wholesaling. You're just hoping. You're just putting slapping a price tag on this, throwing it out there, hoping people don't ask you any questions about it. And that's not who I want to be. That's why most
right.
people say most wholesalers suck because most wholesalers do suck. They don't understand how to run the numbers. So
It,
right around
you
that
know,
time,
some, it,
I learned.
and you know, something. It's funny you said because when I talk to a lot of wholesalers, a lot of times they don't know the numbers. They
Nope.
don't know
Yep.
nothing about the deal. But I want to jump back just a little bit because with everything that you're saying, with everything that you've said about what happened, I'm going to ask this question here. What would you say are the fundamental principles of underwriting? What would you say?
Got it. So here's how I define underwriting. I define underwriting as asking the question and getting an answer to the question: is there a deal?
Right.
If there is a deal, how good is the deal? If there's not a deal, what do I have to do to make it into a deal? What do I have to change? What do I have to adapt to make it into a deal? Because that's the mental exercise. Yes or no? Okay, great. But if it's no, okay, what would you have to do to make this into a deal? And that practice, that mental exercise is the process of underwriting. You're seeing where the opportunities lie, and you're trying your best to figure out which ones are likely to happen, which ones are
Right.
less likely to happen, and how do I?
Hmm.
It's a risk assessment, right?
Yeah.
And it is it's a never-ending journey. No one, there's no peak of underwriting. You're always learning new strategies and new techniques and stuff. So you're never done. But it's like engineering, right? There's always a problem to solve. In fact, it is financial engineering. So there's a problem that's out there to be solved, and you're looking at all these tools you've got to figure out how you can solve it. And that's one of the reasons why I enjoy it so much now. So what I did in 2014, we tried to wholesale and we failed miserably. Why? Because in 2014, I still hadn't learned how to analyze a deal. So for those of you who are uncomfortable analyzing a deal, here's the resource that I use. It costs $15 on Amazon. A guy named Frank Gallinelli has a book called What Every Real Estate Investor Should Know About Cash Flow and 35 Other Key Financial Measures. That became my Bible. I took that book and he starts you from the beginning, from collecting rent. He takes it through operating expenses and capex. And by the time he's done, he's talking internal rates of return and inflation adjusted. Yeah, we'll definitely make sure that that book is out there because that, again, when people say, "Oh, I don't understand how to run the numbers," I'm like, I understand it. No one was born knowing how to do this stuff. I wasn't. I mean, again, if you asked me in 2007 how to do this, and I would have had no idea. So
Right.
everybody that knows it learned it somehow.
Right.
And
Some
some people
right.
can learn from a book, and some people can't. But if you're the kind of person who can get it
Mhm.
from a book, this is the book that I recommend that you get because all the terms that you hear out there are explained in this book. And what I learned by reading the book is that there's actually a meaning to operating expense, and it's different from capex, and you can't interchange the two. There's a meaning to cash on cash return. It's not just hand wavy. Hope nobody asks me any detailed questions. No, this is actually a mathematical. And again, I'm throwing myself under the bus. If you had asked me, I would have made some stuff up. It would have sounded plausible, but it was not the definition. And
Right.
I want to know because I don't want to have to rely on someone to tell me this is a good deal. I want to know it's a good deal. I want to have the confidence to say this is a good deal and here's why. And if I can't defend the deal, then I don't really know what I'm talking about. And I know a
Right.
lot of people they just kind of go along.
Mhm.
Real estate investing is not a place for people who want to go along. You need to know for yourself that
Right.
this deal makes sense or it doesn't. And the way that you know is you learn. And the good
Yeah.
news is
Yeah.
that it doesn't cost tens of thousands of dollars to learn this stuff. $15 book. I got the Kindle version. I carry it to this day. I go through that thing every now and then and just make sure I've got my stuff straight. But he walks you through all the terms and he has examples. And I mean, it's, in my opinion, it's the best way to get this
Sound
thing
like a
done.
good book. Sound like a
It's a
good
great
book
book.
to me.
It's a
Sound like a
great
good
book.
book. I'm about to check it out myself. You know.
Um, and
So
so,
so but after you read that book, what was the first what's the first data that you want to collect? After you read that book and you say, okay, I'm good, what's the first data that you want to collect to start
so
your underwriting?
fair question. And so again, just to remind people, at the time I was doing single family
Yeah.
houses,
Yeah.
and the question that I needed to ask was,
Mhm.
and again, my son of wholesale, what do my buyers care about? And my buyers, my wholesale deal buyers, who are mostly cash flow buyers, care about cash flow and they care about cash on cash return. And when I went back and looked at my deals that I had been putting out there and I ran those numbers, my cash flow was like $80. And my cash on cash return was like $3, 3%. And I'm like, oh, these numbers kind of suck. I'm like, okay,
Right.
that's why no one's buying my deals.
Mitch, I want you to hold tight now. You're starting to get ahead of me. You're moving too fast. I don't want you to don't dwell on don't talk about that cash flow too much because there's a particular question that I'm going to ask you that's going to bring you back to the cash flow.
Got it.
Okay. So you're good. You're getting ahead. But if you could continue on that path, but just go around the cash flow a little bit, because I am going to ask a particular question that's going to bring you back to that cash flow. Okay.
Okay.
All right.
Um, so so I needed to understand. I mean, if you're talking rental property, you got tenants who pay
Yeah.
rent,
Yeah.
which I understood that part. I got that part. What I
Right.
didn't understand is okay, but there's also expenses. You get taxes, you get insurance, you get vacancy. Vacancy is a real thing. You don't get. I see people all the time. They put 0% vacancy because the tenant's already living in there. I'm like, just because the tenant's in there today doesn't mean the tenant's going to be in there forever.
Right.
So vacancy is a real thing, and it happens, and it's going to happen guaranteed. So you need to have a vacancy number. Same thing for management. People put 0% property management because I'm doing it myself. Like just because you're doing it yourself doesn't mean that that expense goes away. You
Right.
spend the money to hire a property manager, or you spend the time to do it yourself, but you're spending that money one way or the other.
Yeah.
And again, I didn't understand that in
Yeah.
2007. So in 2007, I did my own property management. It's a whole nother mistake. But anyway, my big point is that when I started to break it down, I realized, A, all those years before, I barely was making any money. When I actually ran the numbers, I was getting like $26 in cash flow. And I realized that's why we were always struggling because even though we were doing
Right.
tons of deals, we had tons of properties in our portfolio. Each one of
Right.
those properties was not performing as well as it should have. And had I run my numbers, I would have known this. I did not run my numbers to my everlasting shame. And so they say there's no zealot like a convert. That's me now. Me
Right.
now is get the numbers, understand the numbers, practice the numbers.
Right.
I underwrite the deal at least once or twice a day. People send me stuff and I run through the numbers and I'll go either A, why'd you send this to me because it doesn't make any sense, or hey, this looks like a great deal. Let's talk about how we can do more of this. But the it is a muscle like every other muscle that we flex. The more you use
Yeah.
it, the better
Yeah.
you get
Yeah.
at it.
The better you get at it. Um, so would you say that because the question was what was the first data that you would collect? So would you say that the first data that any new investor and seasoned investor should collect would be the data, the numbers to evaluate that property?
Absolutely, absolutely. You've got to. I mean, the purpose of a rental property is to provide a place for people to live so that they pay you rent. So I want to see rent roll. I want to see how much you're
Okay,
collecting in rent. I want to
okay,
see expenses. How much are you spending on the things that you have that you don't have a choice to spend? Operational expenses. These aren't optional. These are essential expenses. And having those, understanding what those are, how those get determined, is crucial. I'm seeing right now. I'm seeing people who bought property last year and this year, they're seeing their property taxes soar. And I'm like, okay, but that didn't happen overnight. And the county that's taxing you knew that that was going to increase last year. As part of your underwriting process, you should have been looking to see what the trends were for tax increases
right,
and anticipated. So again, all this to say that there are tons of ways to go wrong if you don't do the underwriting.
right.
And if you do, it's a never-ending battle because there's always new things and new angles to consider. But the challenge is to understand that in order to get a complete picture, it's income and it's expense. And if you
Gotcha.
can get your hands wrapped around those, then you can start talking. Okay, now let's talk about how we're going to finance this thing. Let's talk about capex and how we're going to improve it over time.
Right.
But getting that understanding is the essence of underwriting. And as an investor, we should love that. That should make us excited. That is, in my opinion, the sexiest thing you can talk about to an investor should be the numbers. I don't care about what the kitchen looks like. I don't care about how nice the bathrooms are. I mean, I'm not going to live in this house. It doesn't matter to me how nice those things are. I'm sure someone will enjoy it. What I care about is show me the numbers. Show me
Right.
and walk me through it so that I can be comfortable that this thing is actually going to make us money. And if it makes us money, now I'm smiling. Now I'm happy, and now I'm engaged.
Okay.
The marble and the brass, that's nice, but that doesn't make me any money. I had all that stuff back in 2006 and I wasn't making any money. So I need to understand the numbers because that's what's going to protect me from the disaster that I experienced in 2007.
So now I want to jump into because you mentioned two very important documents. And the two important documents are the T12 and the rent roll. Right. So what I like to do, because I like to be visual, and I like, because there may be some people here that's new in underwriting. They don't know what a T12 look like. They don't know what a rent roll look like. So for the purpose of this, I'm going to show you what a T12 look like. Okay. I'm just going to show you. All right. So this is what a T12 look like right here. Okay. You have you have your, oh, you go. You have the income up top. See right here, it says income. You have your income here. You have your this is all part of your income. See, other income. Then you have your expenses down below. So let me just ask a question here, Nick. I mean, Mitch, when you're looking at your T12 and you LP on some deals too, right?
Well, so let me be clear. I am looking to, and I have my team and I have been looking at deals for the last 3.5 years. We
Right.
have not pulled the trigger yet, and pickings have been slim for these last couple of years. We're just starting to ramp back up again because we're starting to see deals come to us. So we're starting to look at
Good.
stuff.
Good.
We have actively engaged at looking at deals both from an LP side and from a GP side.
Good. So when you look, so now you're underwriting deals, and you've been you're starting to underwrite deals. They're picking up. What is it that you look for in the T12? And this is only everyone. This is just a sample. This is just sample. That's all this is. Because I wanted y'all to see what a T12 looked like. Some people, you know, the new investors who have never underwritten, you may not know what a T12 like. Now this is now everyone listen. All T12s don't look alike. This is a beautiful T12, right? Some T12s, they're going to come with very little information.
Mm-hmm.
Some comes with a lot of information. But the one thing that Mitch said, and I want to use how he said, um, wait a minute, I believe Mitch said, and correct me if I'm wrong, financial engineer.
Mm-hmm.
You did say that, right?
I did.
Okay, so now you are a financial engineer or a financial forensic underwriter,
Mm.
and you have
I
to
like
go
that.
through this. Okay, right? So Mitch, when you're looking at your T12, what is it that you wanted to say to you?
So that's a great question. That's an awesome question. And because in most cases, well, in all cases, the T12 is provided to us either by the broker or by the management company or by the seller. It is, how should we put this delicately, suspect, right? Highly suspect, because they're trying to sell this thing. And so they're going to present it in the most favorable light. So one of the things I look for, actually, what I look for is what's missing. I look
Uh-huh.
for what they, because for example, they don't always show vacancy. Typically for larger operations they will, but for some small operations they'll say, hey, we're 100% occupied, so there's no vacancy. That's not quite how the way it works. I want to see property taxes. I want to see insurance. I want to make so think of it. I think of it this way because I'm an engineer. I'm not technically a car guy, but the car metaphor helps people.
Right.
If you have a car, if someone says to you, "Hey, I've got this car and it's a really great car. It's really fast. It goes 20 miles an hour." We would all kind of laugh and go, 20 miles an hour is nothing. That's not particularly fast for a car. Not these days. So we all understand that fast for a car is 200 miles an hour, 120 miles an hour. That's a fast car. And if you're a mechanic, you understand that for that car that's going that speed, it should have a certain amount of engine pressure. You know what those norms should be. You know what the standard should be. And so when you look at any car, if they go, hey, the car is going this speed, the pressure should be this much, and you check it and it's not, then you go, oh, something's wrong here. Something's unusual about this. Let me go dig a little deeper and find out what this one's doing that's different from all the other ones I've seen in the past. Okay, same thing here. I'm looking at, okay, it's an apartment. Fundamentally speaking, all apartments pretty much do the same thing. So if I'm familiar with the area, with the market, and I know, for example, what property taxes should be, and I look on here and property taxes are way less, then I'm wondering to myself, okay, what are they doing that everybody else in the community is not doing? Same thing for insurance. So I'll try to use the norm. That's why analyzing a lot of deals in your market is so powerful because you start to get a feel for what it should look like. And so when you
Right.
see an outlier, you go, huh, this looks a little different. And then you kind of dig a little deeper and see what's missing. So I'm looking for what's missing. I look a lot for what things they're not including in here. I look for things that they are including, what ratio between the let's say um, property taxes. I can go and look up what the millage or what the property tax rates are for that particular municipality. So if for some reason they're off, I'm going to wonder why didn't they show the full amount of the property taxes on this T12. So I like the idea of the forensic analysis because that's basically what you're doing. You're trying to figure out how, what's really going on underneath the surface here, and
Right.
you're doing it with to some extent a hostile witness because they're not trying to tell you the full story. They're trying to present the most favorable light because they're trying to sell it. But
Right.
when they ignore real expenses, they're basically inflating the income.
Right.
And since in most cases they're going to base their valuation on a ratio between the income
And the
and
expense.
yeah. So I
Mm.
need to understand how that whole thing works. And it's not the larger the project, obviously the more time this is going to take. So
Mm.
digging in and diving in is part of this whole process. But you get to love that part because you're exploring, you're trying to figure out, what's the story here and how does this story work and how do I see opportunity? So there's the what's missing, and then there's also the what can be improved here. What is of what they're showing me? Where are the opportunities to make things better? So if they're not getting market rent, if they're vastly under rent, then there's an opportunity perhaps for me to do some things and get better rent. If they're not collecting rents as thoroughly as they should be, if they're losing lots of money to non-paying tenants and such, maybe that can be improved. So it is the the T12 speaks to you, and if you listen to it, it tells you here are the opportunities to make money with this property. And if you listen, and if you train your ear to listen to it, it'll walk you through how this can possibly be the case. And so that's why it's exciting to me to do that because the more of these you do, the easier it becomes to hear that voice. For those of you who ever read Reginald Lewis's autobiography, Why Should White Guys Have All the Fun? He has an entire chapter called I Was Not Ready, when he talked about how he would go through all these financial uh, reports for these companies and read them and just read them, and then eventually he found the gem in the one that he actually ended up doing. So it's the same thing here, and the more practice you get, the better and faster you get at it, and that's when you start to figure out, oh, okay, I understand how this thing works, and then it's like it becomes a whole different thing. It's not a drudgery anymore. It's not a pain. It's let me at this G12. Let me at this documentation so that I can see where the opportunities are. Because if you can see them and somebody else can't, then you can buy stuff that other people won't buy. And you can
Right.
turn that stuff into gold. When they're looking at you going, why would you buy this? You're like, trust me, give me a couple of years and then you'll see why I bought it. So for me, that is the exciting part of this business is seeing jewels and gems where other people don't. And also avoiding some of the pitfalls and stuff that people are presenting to you, and you go, I help me understand where the opportunity is because I don't see it. But it's a language, right? Underwriting is a language, and once you can speak that language, it is everything is so much easier.
Underwriting is very important for you to know. Without knowing the valuation or how to value property, you can never get no money. If you can't explain your underwriting, you can't explain how to get that capital. I have a coaching program and we talk about underwriting. I teach underwriting, the importance of underwriting, why you need to know underwriting, what's involved with underwriting. If you want to learn more about underwriting, join my coaching program. My information will be below. So, all right. So next, so now I want to jump over to the second part of that underwrite, and that is what does right? Because I showed you a T12, but now there's two parts to underwrite, and that second part is the rent roll. So for
Yep.
those of you who have never seen a rent roll, right? This is what a rent roll looks like. Now, this rent roll is pretty clean. It's been, I done highlighted on it. Again, this is a sample, everyone. This is only a sample, but I've highlighted on it and stuff like that because, vacancies and stuff like that. Okay. But now, and all rent rolls don't look the same. You may have a rent roll that's really long. It gives you not just the rent, but it gives you like, it gives you the rubs, it gives you the parking, it gives you the pet fees, it gives you all of that. But I'm not gonna say what you want. I'm gonna let because this is an interview, right? So, so what I'm gonna, so now I'm gonna ask this question here to Mitch. Mitch, now you done analyzed the T12. Now you're looking at your rent roll. What story are you wanting to hear about this rent roll?
Yep, that's a great question. And again, I think what you're doing here is brilliant, and I think it's so smart to be able to tell the story this way to people so they can see exactly what you're talking about. Because I am visual, and being able to see it makes all the difference. What I want to hear from the rent roll is I'll just give some examples. I want to know what the mix is um, in the unit mix. Um, so is it all one bedroom, one bathrooms? Is it all two twos? Is it a mix? I want to understand that. I want to understand, and I see you have it here. You have rent, and you also have market rent. So I want to see how much of a gap, how much daylight there is between what they're actually charging and what they could be charging. I want to see if there are any concessions that are being offered to tenants to get them in there. I want to see how long these leases are. Are they typically short-term leases? Are they long? I saw one in Tulsa a couple of years ago. It's like a 5-year lease below
Oh,
market rent. Yeah, I'm like, why would you do that? But that's a whole different story. But the rent roll will show you that. It'll show you how long the lease is for, when it started, when it ended, and what the amount is, so you can see if it's below market or not. Uh, I want to see if there are any outstanding balances. I want to see how they're handling those outstanding balances, and if they're starting to get unnecessarily large, because a good property management company shouldn't be letting tenants get more than a month or so late, and even a month is on the extreme side. And if I'm seeing 3 and 4 months worth of rent unpaid, I'm thinking there's a property management opportunity here, opportunity slash challenge. But so the rent roll can say all those things to me. Are they collecting? I see you have a deposit column. Are they collecting deposits for all of the tenants? Because we always did that, but sometimes people don't abide by that. And so, if tenants move out and there's no deposit, that's going to fall on the operator to have to cover those damages if there are damages in the unit. So this is a very, very valuable document because it gives me an idea of who's in there and how they got in the first place, what the how the property management is managing this resource, which is the tenants of the property, and it absolutely tells a story, a very important story. Yeah, that's background noise. An important story that you need to understand before you buy this thing, because the day after you buy it, all these tenants are now your tenants.
right.
So until then, there's someone else's problem. But the day after you buy it, it's now your problem. And uh, if you happen to be in a state where eviction is challenging and expensive, then you are going to be living with these people for quite some time, and you need to understand exactly what's going on. But even if they're not, even if you can get rid of tenants quickly, like you can in Georgia, you got to understand what's going on here. And this story that's being told is one that you need to be able to hear.
Right. Great. Great. So now, so now we're going to take that next step, everyone. We reviewed the T12. We have reviewed the rent roll, and we have inputted that data into our model. I'm not going to show you a model because there are so many different types of models out there. So I'm not going to show you a model, but you could Google an underwriting tool for commercial multifamily, and you'll see that there's a ton of them will come up, right? So, but I do want to ask this question right here, and then this question is going to lead to that cash flow question. First question is, after you have inputted all your data, what are the metrics that you're looking for that says, I'm going to take this to the investors?
Great question. So I'm looking for, again, based on my experience, and again, I recognize that as a multifamily investor, it's a little bit different. But because I got burned so badly in the appreciation situation in Atlanta, because we lost a ton of equity overnight, effectively, my bias is toward cash flow. I know that these things, and the great thing about commercial property is that cash flow is tied to valuation. So unlike single family house, where you get what you get, the more cash flow you can create, the more value that you have for the property. But my number one metric is cash flow. My number two metric is cash on cash return. I want to know, to the extent that I think of a rental property as a little engine that generates cash. I want to know how efficient is my engine, and for how much money I'm paying, how much bang am I getting for my buck? And the cash flow tells me how efficient the engine is at producing the thing that I want, which is cash. And the cash on cash return tells me how hard that engine is working for me. A
Gotcha.
5% cash on cash return is okay, but a 10% cash on cash return is working twice as hard to deliver for the same amount of money, same amount of purchase power,
Right.
twice as much cash for me, and that's a good thing. So those are my two numbers.
Gotcha.
Those are obviously those aren't the only two, but those are the first two that
Right.
I look at.
So I'm glad that you mentioned that, because now that next question is, because to me, um, a lot of investors get caught up in IRR, equity multiple, cash on cash, right? They get caught up into those numbers. Let's say that those metrics never even existed. You never had an IRR. You never knew anything about an equity multiple. And let's just say you didn't know nothing about cash on cash. But what you do know, you got your income, you got your expense, you got your NOI, and you have your debt service,
Yep.
right?
Yep.
What would and I know I can how what would you look for, and how much of that would you consider to be a good deal that you would take to your investors?
So again, so it's a fair question. It's actually a great question. For let's just use um, Tulsa, Oklahoma, because I'm looking at deals right now in Tulsa.
Okay.
Uh, I would love to see cash flow, net cash flow. I would love to see cash flow, net cash flow of $100 per door. That would be awesome if I could see that.
100. Okay. So,
Um,
you know, now, something I've asked that question to other investors. I never got a solid answer, but you gave me a solid answer.
yeah.
And the reason why I like solid answers, everyone, is because one um one of my backgrounds is nursing. So I'm a pediatric nurse, a pediatric burn nurse. And as we go through nursing school, we are taught facts. We are taught things to look for, and those are metrics. I know if your blood pressure is high. I know if your blood pressure is low. I know if your blood sugar is out of whack. I know certain things. I could listen to your heartbeat, and I could tell if your heart is in rhythm or out of rhythm. I could tell. Okay, I could take your pulse, and I could tell if your heart rate is irregular. So the reason why I asked that particular question to investors, because there are so many investors, they don't have the slightest idea of how much of a cash flow they should. How can I put this? That they should consider to be a good deal, and that's no joke. They get caught up in the IRR, the equity multiple, the cash on cash. But suppose those metrics never existed,
Mm-hmm.
then what would you look at to say that this deal is a good deal? So, so that is excellent. And it's the cash flow that you said, and $100 a door. So
And just
now,
to be clear, I will
right,
accept that.
right,
That wouldn't make me delighted, giddy, but at least that tells me that property is worth considering. I'll take a closer look. And I got to say this because this has been. If you hadn't said this just now, I could have guessed this. The two most represented categories of successful investors, real estate investors that I have ever met across the board: engineers, nurses. Every single, yeah, you're like the fifth or sixth person that I know personally who's in real estate that's not doctors and nurses. And the reason why I believe that's the case is because nurses are the people who actually get stuff done. The doctor may do the operation, the nurse is the one that gets you back to health. And so I had to say that because I'm not
right.
surprised at all that you have a nursing background because some of the people that I know who are crushing it out here are either engineers or the nurses. Those are the two careers that I see over and over and over again in this business. Anyway, that's a slight digression. But yeah, I'm looking for, and I completely agree with your point because it's easy to get lost in the math. And at some point, you got to realize there's an actual building out there with people actually living in that building. They're paying monthly rent. There's expenses that come out. The multiples are theoretical. The cash flow is real. The cash flow is
That's
going to
right.
land in someone's bank account at the end. The multiple is not going to land in anyone's bank account. That's a concept. That cash flow is real. And if you've done your math right, at the end of the year, you should be able to see that cash flow showing up in someone's bank account. And I think it is important to start from there because you're right. If you don't have that, none of that other stuff matters. And if you understand how to get to that, then all the other stuff is just manipulation of formulas. That's the easy part. But understanding how that number came about and all the assumptions that had to be made to get to that number, that's what makes this a worthwhile discipline for us to pursue. And I'm glad that you're taking that approach with people because that practical approach is what all the greats. If you hear Warren Buffett talk about stocks, he's not talking about financial models and complicated. He's like, if you can't do it on a calculator, I don't buy the stock. He's a very fundamentals kind of guy. And the people who win in this business and in pretty much most businesses are fundamentals people.
Yeah. Yeah. You're absolutely correct. You're absolutely correct. So I don't want to monopolize it. I want to my co-host. I know my co-host got some questions. Alicia, go ahead. What's some of the questions that you have, Alicia? Jump in here.
I almost forgot I was on mute. Thank you so much, Mitch. You have been sharing so many valuable tips. I appreciate the fact that you said nurses and engineers because that's also what I've seen in military professionals,
Yep.
either
Yep.
actively serving or
Yep.
retired. So that's awesome. And Darryl has both of those
Mm.
in his background. Um, I've not met anyone that has really talked so much about underwriting as Darryl has, and I think you're right up there with it. People they just don't really understand the numbers tell the story, and the story is not going to lie to you. It is
Yep.
what you're seeing, unless there's something that they've omitted, and then you find that out during the due diligence period. You mentioned something early on in our call about property management and self-managing, and you said self-managing, that is a big mistake. So what do you mean as it relates to that? Because I've seen some self-managers that are very successful, but I've seen many who are not.
Yeah. So I I made two major mistakes, in my opinion, in my real estate career. The first one was not knowing my numbers. The second one was self-managing. And it's not that I regret learning the skill, but what I didn't understand back then is that property management is a thing. It's a legitimate expertise. And it is parallel to real estate investing. So you can do one, you can do the other, but every minute you spend being a great property manager, and I ultimately became a great property manager, but I did so at the expense of what I could have been doing as a real estate investor because they both require a significant amount of time. It's like being your own attorney or being your own doctor. You can do it, nothing wrong with it, but every minute that you're spending being a great attorney, you can't be a great doctor. So you have to make a decision. And a lot of people make the wrong decision because and this is what most people do, they do it based on cost. They think that doing it themselves is going to save them money. And that is the big lie in property management. If you're doing it because you want to learn how property management works, by all means, do it. Learn how to do that and then move on. But if you're doing it to save yourself money, understand that you're not saving anything. And in fact, you're costing yourself money because the time it takes you to learn property management to get to the level where you can actually be effective, all those mistakes you made are costing you. And as a practical matter, when you're managing a tiny portfolio, you don't get the attention from contractors and repair people that you can trade people that you would when you have a large portfolio. So you get neither the best price nor the best attention. And attention and price are related, because if it takes you 3 months to get something fixed that I can get fixed in 3 weeks, then that's a cost. There's a cost associated with that. So if you're doing it property management because you want to learn it, by all means, do it, get that skill, get that merit badge, and then move on with your life. But if you're doing it because you're going to be saving money, then understand that you're not saving anything. The function has to be performed. And either you're going to pay money to have someone else perform it, or you're going to pay money and time to perform it yourself. And I did not understand that when I was doing it back then. I did it for the same reason that a lot of people do it. And I didn't understand that until I started running my numbers. Because when you run the numbers, there's a big old line item for property management. And it is never zero. Even if you're doing it yourself, it can't be zero. Because it costs. Tenants are not going to manage themselves. Someone's got to do it. And if you're doing it yourself, then you're simply taking on that job for whatever cost that, whatever fee that, whatever the hourly wage is, that's now your hourly wage for whenever you're doing that function. And when you see it that way, you're like, well, then if I don't enjoy it, why am I doing it? Why don't I just hire somebody to do that function and then manage them? So if your complaint is, well, I don't like the way my property manager is doing it, well, that's a management issue. Manage them better. As an asset manager, manage that property manager better, but don't think, and it becomes obviously impractical for multifamily. If you get a 200 unit, you're not going to, no one person is going to manage that themselves.
Right.
But for single family, I see this all the time. People kidding themselves and thinking that they're going to save money by doing it themselves. And again, I can throw myself under the bus because I did this. I don't mock those people, because I was one of those people in 2006. But once I ran the numbers and understood how that worked, I'm like, oh yeah, you know what? I didn't save anything. In fact, it cost me money to do this, and it didn't allow me to fully express myself as a real estate investor. So yeah, those are the two big mistakes that I made in my real estate investing career. And they weren't fatal mistakes. I learned, and I am much better now because of the experience that I had. But I tell people who are just getting started, if you're going to do property management, do it for a year, maybe two, but don't make this a habit, because it will impair your ability to invest fully, because it requires its own time and energy and effort.
Right, it does. I am a former property manager. So I did it for over 25 years. I've been in the industry for over 25. So a
So you
lot of
know.
what you're saying is true. Yes. It does take a lot of your time. Darryl and I have had this discussion. You know, if you're trying to do it to stabilize your property, get it back on feet, that's great. If you're trying to do it to acclimate yourself and learn your property, that's good. But then tag team someone else so that you can leverage that asset and get another one. What's your sweet spot? Like, what is the type of property you enjoy investing in? Think that the numbers are really good in that type of region. So is it only multifamily? Is it other assets? And then what size of a property or unit?
Got it. Great question. So we are right now, we are looking at smaller multifamily. Smaller would be under 100 unit multifamily, just because I want to crawl before I walk, and walk before I run, and I want to understand how this whole thing works in to a limited extent before I try to take on something massive and expensive and such. So for me, that's been my thinking. And I think more in terms of market than in terms of asset class, because in the right market, I'll do pretty much anything. And as we all know, well, or many of us know on this call, the cool thing about underwriting is cash flow is cash flow. The terminology doesn't change when you talk about single family versus multifamily versus self-storage versus mobile home park. They all have people paying rent. They all have expenses. The same numbers come out: cash on cash return, cash flow, net operating income. And so once you understand how to analyze a deal, moving from one asset class to the other is not that big a shift, because there are a few other unusual expenses for some versus others, but the terminology is the same, and the understanding that you have to take away is the same. And so we're open to anything that generates income over time in a market that we like. As I mentioned, we got our start in Atlanta, and for those who might not remember, in 1999 in Atlanta was just after the Olympics, and so pre-Olympic Atlanta was just getting the ball rolling. Post-Olympic Atlanta blew up, and from the 90s to now, Atlanta, I think we saw median prices go from like 100,000 to like 400,000 in Atlanta. So now Atlanta is now an extremely expensive market. So even though I like Atlanta, theoretically, it's just super expensive. It's hard to find really great opportunities there. So I'm looking at now the next up and coming Atlanta. And for that, I like, I almost don't want to say what I like, but I'll say it. I like Tulsa, Oklahoma. I'm starting to like Harrisburg, Pennsylvania. And I'll just throw this little shout out to Harrisburg and Pennsylvania in general. U.S. News and World Report does a measure every year of the best places to retire. And I think out of the top 10, 7 were in Pennsylvania. And number 1 was Harrisburg. And I'm like, what the heck's going on in Pennsylvania? And the answer is, I don't know, but I need to find out. But what I do know about Harrisburg, because we've done some private lending there, is that it's an affordable market. And I'm starting to figure out that I like affordable markets where you can get in cheaply and things haven't all been set in stone yet. There's still opportunities. There's lots of old housing stock in places like Harrisburg. Same thing's true for Tulsa. Atlanta used to have that, but pretty much all that has been bought and converted now to new stuff. So I'm looking for places where I can find still opportunities where it's not so run down that it's a risk. I mean, I hear people talk about Detroit, and I wish it the best, but Detroit's been on the way up for like the last 20 years. And I'm waiting for it to finally get there. Maybe this will be the one time that it actually does it. But I like Philly. Same thing with Philly. I see people talking about Philly, and I'd love to see Philly take off. But I'm seeing it in certain markets, and I'm trying my best to find those markets where it makes sense. And then for those, I do just what I said here. I dive into some deals. I start doing some underwriting, learning the market, learning what the opportunities are, and kind of get smart on that market. And then I can see the opportunities. Because as we've just discussed, if the financials do speak to you, the more of them you read, that one voice becomes a chorus. And now it's all saying, yes, this makes sense, and here are some opportunities. And if you listen to those voices, then you can decide where you want to buy.
Awesome. Thank you so much. I'm handing it back to Daryl.
All right.
Short on time.
So, Mitch, it's 12 o'clock and we got to wrap up. But what I would like to ask you is this. If somebody have a question, because I know Miss Stephanie has a question, I would like for her to reach out to you. If someone would like to reach out to you to ask you a question from today's show or just to ask you a question, how can they get in contact with
you? Yeah. I am a networking monster. So the best place to reach me is LinkedIn. You can find, I'm the only Mitch Messer there. If you search me, you'll find me. If you reach out to me, I'll connect with you, and then let's talk, because I can't tell you how many great opportunities have come completely out of the blue. Everybody is an opportunity and is a networking contact. Everybody knows something that you don't, and if they're willing to share with you, everybody gets better and smarter. So come at me. Let's definitely do some networking and see how we can help each other be more successful.
Fantastic. Everyone, this recording, it is going to be on YouTube. And I will have the link sent out to you and to Mitch. And Mitch, and everyone, I'm going to ask you all, if you like what you heard today, I'm asking you to go to YouTube. Once you get the notification that the video is there, I'm asking you to please go there, help me get my numbers up. Give me a thumbs up if you like what you heard today. But also put questions in there, because if Mitch states something, right? Let's say Mitch says on YouTube right there at the comment, "Yeah, this was fantastic. I enjoyed myself," right? This now you also communicate with him through the YouTube, and it also will help the show here. So I'm asking you, please once the video, and the video will be up today, I'm asking you to please go to the video, gives it a thumbs up that you enjoyed today's show. And if you have any questions, please post it there. And I will also send a link to Mitch so that Mitch will also know, well, he's going to get notification that the video is up. And that way, if if he wants to say something, he can, but you can also communicate with him. But Mitch, I'm gonna tell you something. You dropped so many nuggets, and they're not gold nuggets, man. You dropped some platinum nuggets, and I don't even know what's above platinum, but whatever it is, you dropped it today. Everyone, listen to what Mitch told you a lot. You don't realize it. He told you his mistakes, but he also told you what he did to correct those mistakes. Did you get that?
Mm-hmm.
He told you his mistakes. Not too many investors tells you the mistakes. They want to glorify everything. Like, this thing is really cool, right? No, there's work here in commercial multifamily. And if you come into this industry thinking, well, I'm just going to do this and I could do that. No, 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 no. Go somewhere else, because you're going to hurt your investors. Your investors should always come first. If you listen to what Mitch said, he said he was $6 million in debt. He done got down to only 2. That means he knew he had to bust his behind, pay them investors back their money. That's the kind of man you want to invest with, right there. The one who is willing to sacrifice. So I'm saying to you all, reach out to Mitch, reach out to me, reach out to Alicia. Please, if you like this show, give me a thumbs up on it on YouTube, and it will be released today. Mitch, I want to thank you so much for coming. I want you to come back. I want to have you back. And Mitch, I'm looking at a couple of opportunities. I really would like to work with you and see if we could work together on some of
Well,
these investment opportunities.
It's been an honor and a delight to be able to talk to you and your audience and Alicia. It's been just wonderful. I would love to come back. I would love to talk to you about opportunities. I'd love to work with your team here. There's so much. I mean, we didn't talk about the international stuff. I didn't comment on the fact that I'm sitting here in Lima, Peru, and yeah. So there's just tons of stuff we could talk about. There's many layers to this, but again, people find me on LinkedIn. I will definitely any questions that are asked on the YouTube, I'll head over there when it's available, and I'll answer any questions people have, and we'll see if we can make some magic happen, because this is why we're here. This is why I'm here.
So,
That's
so
my
Mitch,
reason.
I'm going to reach out to you because I want to try to get you back on calendar. Like you said, you're in Lima, Peru right now. I want to discuss that. So I'm going to reach out to you, ask you. I'm going to shoot some days over to you. It's going to be soon, everyone. I'm going to tell you right now. I'm bringing it back. It's going to be like, okay, so here we go. This could be the part 1. This is the part 1. Mitch, I want to get you back so we could do a part 2.
I'd be happy to. I'd be
Okay,
happy to.
sounds
Thank you
good.
so much for
There
having
you
me.
go. Thank
Thanks,
you.
everyone.
Thank you, Mitch, for coming. And
My
thanks,
pleasure.
everyone, for coming today to the Commercial Multifamily Mastermind Show. I'll see everybody in 2 weeks. In 2 weeks, but I'm gonna try to get Mitch here before. But okay, but I'll say everybody September 3rd. I'll try to get Mitch after that one. Let's do a part 2, and we could discuss Lima, Peru, international, and everything. Okay. All right,
Awesome.
everyone. Thank you for your
Bye,
time.
folks.
Thank you for your support. See you back here September 3rd. Commercial Multifamily Mastermind Underwriting Show. Thank you.